Well, we're back with our featured guest, Colin Stewart. Colin, you want to weigh in on the high-value tech stocks and what investors need to understand, and what history has shown us about stocks that dominate the market for a period of time.
Yeah, exactly. I think that's really one of the risks investors need to be aware of today. We know there are a lot of people that are following a passive investing strategy, investing in indexes and ETFs, and a lot of that money goes into the S&P 500, which, as we know, is a market cap weighted index. And obviously, in the last number of years, we've seen this huge outperformance by a very small number of components of that index. In particular, everyone's heard of the Magnificent Seven, how much those stocks have driven the market, how much they've outperformed other areas, the broader index, and then you have the outperformance of the S&P and the U.S. market versus other markets internationally. So we really think that's one of the key risks investors need to be aware of. And we think one of the surest bets is, in fact, a broadening of the market. That hasn't happened yet, but those larger components, and people might think they're taking a low-risk strategy by indexing and putting money in an S&P index fund, but we think that's actually a fairly risky strategy today because those top 7, top 10 stocks trade at high PE multiples relative to history, relative to the rest of the market, and overall the U.S. market trades at a high multiple relative to Canada, Europe, other international markets. And it's sort of funny. I mean, the passive trend where more money goes into passive investing ends up being a bit of a self-fulfilling prophecy, and that money goes into these index funds, goes into the same stocks. The largest component of that money goes into the top 10 stocks. And
right.
History does show over time, over the last 60 or 70 years, buying those largest companies as an investing strategy, those top 10 names, is not a good strategy to outperform.
The example many Canadian investors, at least Canadian investors of a certain age, remember is Nortel Networks, which completely dominated our domestic index here, and then things obviously did not end happily. There are other cases over the years of similar retreats, correct?
Exactly, and it just shows that, I mean, the basic theory is that when those names are in the top 10 or top 5 in the index, it's very well known. And people, in often cases have priced in all of the good news like they did with Nortel. It's not to say that these things can't go further, and we've seen continued outperformance so far this year of those Magnificent Seven stocks outside of perhaps Tesla. But we think one of the surest bets, as I said, in the market is that the market will broaden and the big stocks will underperform, and the index and smaller and mid-cap names will start to outperform.
I know you're not an ETF investor or an indexer, but what about an equal weight S&P 500 ETF? Is that a better idea for investors who like the idea of an ETF?
Yes, absolutely. I think the equal weighted versus the S&P market cap weighted would be a much better bet. We would even advocate, looking at smaller indexes like a Wilshire or Russell 3000, or looking at more international markets, looking at the Canadian equity market. But if someone was looking for exposure to the U.S. large cap stocks, we would definitely advocate an equal weighted index versus the market cap weighted.
So in a minute, you're going to talk to us about demographic trends and a couple of particular stocks that you think work in that context. Leaving that conversation for our next conversation, what kind of portfolio moves are you making on behalf of your clients now, given your concern about the big name tech stocks?
Yeah, exactly. We're just trying to make sure we don't have a lot of exposure there. We own a little bit of Google in our funds, which is a great company, probably one of the more reasonably valued of the Magnificent Seven. But outside of that, we've sort of reduced our exposure to some of those larger tech companies. We've broadened our portfolio, focusing on the Canadian equity market versus the U.S., where we think multiples are much lower, better value exists. And, just looking, I think, outside of the most popular sectors, areas like perhaps healthcare that have underperformed, consumer staples, utilities, more defensive businesses that don't trade at those high multiples that some of the hot areas of the market like tech do, which, as we know, has really been propelled by the hype around AI and all of the growth that people are seeing in that area of the market.
Canada versus U.S.?
Yeah, I think Canada's, on a relative basis has underperformed for a long time now. And I think if you look at historically the PE multiples of Canada versus the U.S., it's at about the largest gap that we've seen, i.e. Canada being cheap relative to the U.S. market on a PE basis, pretty much the largest discount we've seen of Canadian stocks versus U.S. in the last 30 years or so. So we definitely would advocate an overweight in Canada versus the U.S.
That's